on Friday. Well, let's talk about this and other pharma stocks a little bit more. InCred is bullish on especially the diagnostic space over the next 12 months, but it's bearish on unbranded generics. They also add that they're positive on hospitals where valuations according to them are a bit more reasonable. Aditya Khemka is fund manager at InCred Healthcare Portfolio PMS. Aditya, good morning. Good to have you with us here. Thanks for your time. Prashant this side. Just to kind of sort of take off from what Ekta mentioned, do you track, own, cover Shilpa Medicare?
No, we don't own it, but we do own a number of CDMO businesses, and we have said in the past that we are fairly bullish on the CDMO space, especially where companies deal with innovators. This is a high margin, low volume, high ROE business, which we are very bullish on. And because of China Plus One, the order book of all these companies are swelling. So because we can't own everything in this space, we have our own picks. We own Hykel, we own Newland, we own some other names, Jubilant Pharma, etc. in the space.
Okay, Hykel, Newland and Jubilant Pharmova is what you said, right, in the CDMO business. Got that. You're also bullish on the hospital space where you feel that valuations are now reasonable. Take us through that and which are the stocks you like there? What is the kind of growth you're looking at over the next 12 to 18 months?
Yeah, so many hospital stocks actually are trading at 20 times, 22 times EV to OCF. I think the mistake that people generally make is they focus too much on price to earnings ratio. Now in real estate or capital intensive businesses like hospitals, earnings tend to be very low given the high depreciation and amortization that these companies have. So we don't really look at price to earnings, we look at EV to operating cash flow. And if you look at some of the hospital names that we own, which is Healthcare Global, Aster DM Healthcare, these hospitals trade at 20 times, 22 times EV to OCF, which is essentially the same as PE ratio, but it is cash earnings and not really just accounting profit. So that, to my mind, is a fairly reasonable, multiple for a business which has negative working capital, longevity of earnings, high margins, and sticky business above all. So yeah, we like the hospital space, but not everything. Not every stock can be painted with the same brush. So some of the hospitals are trading prohibitively expensive, and we don't own them.
All right. Hi, Aditya. Good morning and good to see you. When I want to ask you about the diagnostic space, one of the rank underperformers in the last 3 years or so is Thyrocare. In spurts, though, you're seeing a fair bit of delivery-based buying. The question is, how much of the bad news is in the price at around the 650 levels? The last quarter's numbers actually was quite good, and the guidance given as well by the management was quite optimistic. Your take?
So in the diagnostic space, we own Thyrocare, we own Krishna Diagnostics. We have been extremely bullish on this space, again, because of the reasonable EV to OCF that these companies trade at. Just to give you a sense, Thyrocare, even at today's valuations, would be trading at close to 20, 21 times EV to OCF, which is basically, enterprise value divided by cash earnings. And that's, I think, one of the lowest, in terms of multiples that it has traded in its own history. So, going forward, be it Thyrocare or Krishna Diagnostics, we expect significant ramp up in earnings. These companies made some operating expenses just as investments to fuel growth. And these expenses are going to pay off in the next 2 to 3 years. And then the top line growth will be higher and operating expenses growth will be lower, which would result in margin expansion and better cash flow even from this point onwards, and which is what keeps us really bullish on the diagnostic space, specifically the two names that we own.
Aditya, got that. Just to look at the broader swath of pharma names here, and I'm just looking at the first half performance. Last 1 year, there are many doublers in the pharma space. Last 6 months, Zydus Life is up some 60%, Glenmark is up 50%, Natco is up 45%, Biocon is up some 32%, Lupin is up 30%. At the bottom quartile are names like, there is Mankind, JB, maybe a Loris Laboratories, even a Dr. Reddy's. How's the sort of pecking order for you out of some of these names that I mentioned?
So out of the names that you mentioned, we own JB Chemicals. I think just the one name that we own out of the names that you mentioned. And again, because you might be looking at the last 6 months price movement. If you look at, let's say, a 10-year movement, a stock like JB Chemicals has probably gone up 17x. When something like a Sun Pharma has gone up 20% or 25%, and something like a Dr. Reddy's has done 30%. This is over a 10-year period, not CAGR, point to point returns. So, you're comparing a 1700% return stock to a 20-30% return stock when you compare a JB Chemicals to a Sun Pharma or Dr. Reddy's. And that's purely because, of the fundamentals. These are unbranded generics, Sun Pharma, Dr. Reddy's, etc. They have a large unbranded generic business, which dictates how their stocks move. And hence we don't own them because we can't really be sure of when the cycle turns. And there is not enough data to indicate that the cycle has turned. Whereas, branded generic companies like JB Chemicals, like Torrent Pharma, like RPG Life that we own, these companies just grow every year. There is no cyclicality in their earnings. There is no cyclicality in their margins or cash flows, which is what we like.
Any thoughts on Mankind? Point taken and well explained, Aditya. Any thoughts on Mankind?
So we don't own it, but I think a post-listing of Mankind, there was a significant rally in the name. So you can't be judging the stock on a 6-month basis.
Okay, well, thanks a lot for that. Appreciate your time here. That's Incred Healthcare with their views on the entire pharmaceutical space. But let's get some 9-10